In 2000, they were worth $68 billion. 2 years later, they were worth nothing. This is the story of WorldCom, a telecommunications giant whose rapid rise and catastrophic fall shook the corporate world to its core. Founded in 1983 as Long Distance Discount Services, Inc., WorldCom began as a modest long-distance telephone company. The brainchild of Bernard Ebbers, a former milkman and high school basketball coach, the company aimed to capitalize on the deregulation of the telecommunications industry. By the late 1990s, it had grown to become the second-largest telecom provider in the United States, thanks to aggressive acquisitions and a booming stock price that peaked at $64 per share in 1998. WorldCom's ascension was nothing short of meteoric. Its strategy was simple yet bold: acquire, acquire, acquire. The company completed over 60 acquisitions during its rise, with the most notable being the $37 billion merger with MCI Communications in 1997. This deal positioned WorldCom as a formidable force in the telecommunications sector, and its stock soared as investors banked on its continued growth. By the end of the decade, WorldCom was serving millions of customers and generating billions in revenue, with Ebbers hailed as a visionary in the business world. But behind this facade of success lay a ticking time bomb. As the new millennium approached, WorldCom faced mounting pressure to maintain its stock price and earnings. The telecom bubble was beginning to burst, and the broader economic downturn magnified the company's challenges. Between 1999 and 2002, CEO Bernard Ebbers and his team resorted to fraudulent accounting practices to inflate earnings. They misclassified operating expenses as capital expenditures, a tactic that artificially boosted profits and masked the company's true financial health. This accounting sleight of hand allowed WorldCom to report inflated earnings, thus sustaining its stock price and deceiving investors. In June 2002, the facade crumbled. WorldCom admitted to accounting irregularities, unveiling $3.8 billion in misclassified expenses. This revelation triggered a cascade of events that led to the largest bankruptcy in U.S. history at the time, with $41 billion in assets. It wasn't long before the magnitude of the deception was fully realized. By the end of the investigation, the total amount of fraudulent accounting was found to exceed $11 billion. The scandal rocked the corporate world, surpassing even the infamous Enron collapse, and sent shockwaves through financial markets across the globe. The main players in this drama were Bernard Ebbers, WorldCom's founder and CEO, Scott Sullivan, the chief financial officer, and David Myers, the controller. Ebbers, once a celebrated visionary, was accused of orchestrating the fraud to keep the stock price high. Known for his charismatic leadership and aggressive style, he was both admired and feared within the company. Sullivan, his right-hand man and financial mastermind, played a key role in the deceit, crafting the complex web of fraudulent accounting entries. Myers was implicated for his part in the scandal, having signed off on the misleading financial statements that misled investors and regulators alike. As the dust settled, the human and financial toll became apparent. Approximately 20,000 employees lost their jobs, and investors faced devastating losses, with stockholder losses estimated at $180 billion. Pension funds, individual investors, and retirement savings evaporated overnight, leaving many without a financial safety net. WorldCom's stock, once a darling of Wall Street, plummeted to a mere 10 cents, leaving investors and employees alike in ruins. The emotional impact on employees was profound. Many had dedicated years to the company, only to see their livelihoods and savings decimated. The scandal's impact rippled beyond WorldCom, prompting significant changes in corporate governance. The Sarbanes-Oxley Act of 2002 was enacted to improve financial disclosures and combat corporate fraud, marking a new era of scrutiny and accountability in the business world. This landmark legislation introduced stricter regulations for financial reporting and increased penalties for fraudulent activity, aiming to restore investor confidence shaken by corporate malfeasance. At the heart of the scandal was a toxic corporate culture that prioritized stock price over ethical accounting, a compensation structure that rewarded short-term gains over long-term stability, encouraged aggressive earnings management, while governance failures and a lack of effective oversight allowed the fraud to flourish. An environment that discouraged whistleblowing and honest reporting only exacerbated the problem. Cynthia Cooper, an internal auditor, became a pivotal figure in uncovering the fraud. Her persistence and courage in the face of immense pressure highlighted the critical role of whistleblowers in maintaining corporate integrity. The WorldCom scandal serves as a stark reminder of the dangers of corporate greed. It highlights the importance of ethical governance and accountability in protecting investors and maintaining market integrity. The lessons from WorldCom continue to resonate, underscoring the need for vigilance and reform in corporate practices. The scandal spurred a reevaluation of corporate ethics and the responsibilities of executives, auditors, and board members in safeguarding against similar misconduct. Today, the name WorldCom is synonymous with corporate scandal. It stands as a cautionary tale of ambition run amok, a legacy of deceit that forever changed the landscape of corporate America. The ghosts of WorldCom linger as a sobering testament to the consequences of unchecked ambition and the fragile nature of trust in the corporate world. The story serves as an indelible reminder of the importance of transparency and integrity in business, a lesson learned at a great cost to thousands of employees, investors, and the broader economy. In the wake of the scandal, Bernard Ebbers was sentenced to 25 years in prison, a symbol of accountability for corporate executives who betray the trust of their stakeholders. Sullivan and Myers also faced legal repercussions, with Sullivan receiving a 5-year sentence after cooperating with prosecutors. These convictions underscored the message that financial crimes would not go unpunished, setting a precedent for future corporate governance. Ultimately, the WorldCom debacle reshaped the business landscape, serving as a catalyst for reform and a reminder of the ever-present need for ethical leadership. It remains a defining chapter in the history of corporate America and a powerful example of the perils of prioritizing profits over principle.